Okay, using the SRS rules to your financial advantage. So rules are rules, but how you play it is really important. Okay, so we all know that if you withdraw early, what happens? For SRS, rule number 1, it's 100% taxed. Plus, there is an additional 5% penalty. So then in this case, what do we do? Okay, first thing is what many don't know. If you do this within the same year, so you put in and take out within the same year, this 5% doesn't apply to you. So this one doesn't apply. So for instance, if let's say this year is 2025, which ends on 31st December 25. Okay, so in March, let's say you decide to put in maybe 15K. Okay, and then in September, 6 months later, you say that, okay, I actually want to take it out, I need cash. So if you take out this 15K, there is no 5% penalty. But then there is 100% tax. However, it doesn't affect you at all because your income is also 100% taxed by default anyway. So it's as if nothing happened. So as long as you put in and take out within the same year, as long as this is lesser or equals to what you put in that year, you're fine. So you do get a bit more flexibility before year end. Okay, so number 1 is on the same year, if you withdraw, there is no penalty. So no 5%. Then the second thing is, this 100% tax is based on the year of withdrawal. So your SRS, whatever that you withdraw, is taxed on that year of withdrawal. Which means that if there is no choice you really need to take out from the SRS, try to do it on a year whereby you have lower income, because the lower tax will help to cushion it a bit. So for instance, if your income is maybe 140K, and then if you try to withdraw 20K from the SRS, then your taxable income becomes 160K that year, which based on the tax brackets will be 13950. Then of course plus the 5% penalty because you're withdrawing early. Okay, compared to if maybe that year you have slightly lower income, let's say 120K, then you try to withdraw again the same 20K from SRS, you will be taxed based on 140K, which is actually 10950 plus the same 5%. So the 5% is the same as 1,000 because it's based on whatever that you withdraw. However, you see that the tax that you pay because of your lower income is lower. So even though that is still the same 5%, the lower taxes help to cushion this a bit. So if you really need to withdraw, do it on a year where you have lower income. Okay, then the second rule is when you withdraw after the prescribed retirement age, only half of it, or 50%, is taxable. So rule number 2, 50% taxable. Okay, so this is the rule. Then how do we deal with this? Then you withdraw only 40K per year. Because if you withdraw 40K per year, you don't pay tax at all. Okay, so how does that work, right? So let's say if we withdraw 40K. 40K and then they say, okay, 50% is taxed, meaning half is taxed, half is not taxed, right? So the first 20K, let's say not taxed at all, meaning 0. Then the second 20K, you are taxed, but it's taxed at 0% based on the tax brackets. So effectively 0 plus 0, you don't pay tax at all. Okay, then the rule number 3 is also with the withdrawal. So once you start to withdraw, you have 10 years to withdraw everything. After 10 years, if there is still money remaining in your SRS account, they will close the account, give you everything back in a lump sum. Which means that number 1, even though you've hit the, let's say, you've hit the withdrawal age at 63, but at this point, maybe you're still earning a relatively higher income. So in that case, it may be a bit too soon to withdraw. So if you don't need the money, maybe you can just keep it in first. Because the moment you start to withdraw, number 1, you can't contribute anymore for tax relief. So you start to withdraw, you can't use the SRS for tax relief anymore, number 1. And then number 2 is, if let's say at 63, you can withdraw, but you don't withdraw regularly after that, then at the end of 10 years, you end up with a big lump sum still in the SRS. They don't care, they will close the account, give it back to you. But because it will be 50% tax, you may end up paying a lot more tax than necessary. Last one, the rule number 5. So we all know that SRS for tax relief, you have a limit of 15.3K for Singaporeans and PRs, right? So rule number 5 is your SRS limit. 15.3k. However, what many people kind of forget about is there is another limit of 80k for tax relief. So this is important, especially if, let's say, you're a working mother, you have parents that you're taking care of, you've maxed out your CPF contributions and everything. Effectively, you may be already very close to this 80k tax relief limit. So let's say if you already have maybe 70k in tax reliefs, then you forget about this 80k limit. Then you top up the 15.3k into SRS. Effectively, you're locking in 5.3k in the SRS for nothing. This is completely wasted. So really just be careful. And then one more thing just before we end is there is a deadline for tax relief, which is 31st of December this year. So it's not by the tax filing date next year, it is by 31st December this year.